So big stocks are outperforming small stocks again this year. Is it time to throw in the towel? Let's take a look. Hi, my name is Eric Blattner. I'm with Divvi Wealth Management, and thanks for watching. Before we jump into the topic for the day, I want to first take a minute just to remind folks, if you enjoy the work that we do and like to follow along, the best way to do that is to head over to divvywealth.com. That's D-I-V-V-I wealth.com, and click on our blog. From there, you should be able to subscribe by entering your email address. That way, anytime we post a new article, it'll show up in your inbox, typically every week. The other way that you can follow along is to go over to YouTube and search at Divvi Wealth Management and subscribe, where we are starting to post more video content, both short and long form, as a means of education. So if you enjoy what we do, please follow along at either of those places, and we appreciate your support. So with that being said, let's turn our attention to the topic of the day. So the title of the post was Small Companies, Small Returns, and that was a question. And we really wanted to take a look for a couple reasons. We're at the time of the year, I'm recording this on Tuesday, December 5th, and we're at the time of the year when a lot of folks will start to take stock and say, how did I do this year? And if you just look at a common stock proxy like the S&P 500, it would look to have been a pretty darn good year. The S&P 500 is up about 20% so far through the end of last week, which is really strong. Now, most investors own much more than just large U.S. stocks. Another piece where folks commonly have exposure is in small caps or smaller stocks. And those companies have returned about 7% this year. Now, 7% is generally going to be a pretty decent year. But by comparison, when large counterparts are up 20%, it feels lackluster. So when you think about it even in a longer term sense, small cap stocks have underperformed large caps for really 12 or 13 years now. So a reasonable person might ask, why do I own these things? Why do I continue to own small caps if they're underperforming? And especially when thinking about, traditionally, the theory suggests that if you take more risk, you should expect to earn higher returns. And generally speaking, smaller stocks, investing in smaller companies, is expected to carry greater risk. There's less certainty in those businesses, in their future. So generally that accompanies more risk, and hence folks would expect to be compensated in the form of higher returns. That just has not been the case since 2011. So we wanted to take a little bit of a closer look. And we looked at roughly 40 years of data, going all the way back to 1979, to try to pinpoint a couple of examples that might be useful. And the first thing that we identified, I'm going to show a chart, a series of charts here. The first one is going to show what I think is important, that there's historically been this phenomenon where small caps may outperform for a certain length of time, and then for one reason or another, leadership changes, and large caps may take the lead, and they may perform really well. And so when we look at this chart, you can see that when those lines, or when that line is going up and to the right, small cap stocks have been in favor. And when it's going down and to the right, that's when these mega cap companies have really performed better. So, at least to my eye, there appears to be about 4 distinct periods, and we highlighted each of those here. And so the first was kind of in the early 80s, where small caps had a pretty good run. And then from the early 80s until late 1999 or early 2000, these mega cap stocks really outperformed. And a lot of that outperformance came in the final years. And for folks that have been investing for a long time, you'll probably remember the bull market of the late 1990s, when the tech bubble was really gaining steam, and a lot of these stocks were putting up just incredible returns for a handful of years. But at the same time, they were also getting very, very expensive from a valuation perspective, and that basically set the table for a 10 or 11 year period of large caps to underperform small caps, and that's what you see here. And so small caps had a really strong decade compared to those bigger counterparts. And then since 2011, the exact opposite's been true again, where mega caps have been in the lead really since the global financial crisis ended in the late 2000s, early 2010s. And a lot of that has been characterized by ultra low interest rates, and now you've got fears over um, recessions heading into next year. So I think there's always reasons to think that certain asset classes might perform well or perform poorly. But to the extent that small cap investors have reason to hope, I think that argument likely rests on valuation. So I'm going to sum up with this table, and it really highlights the different starting points from, again, 1999, when we had that flip from mega caps leading to small caps leading. So basically, mega caps had led up to 99, and then you can see the differences in valuation here, these PE ratios at that point in time, and you saw something similar when we flipped in 2011. So just as a refresher, if you're not familiar with the PE ratio is, think of the P on the numerator, that's price, and then the bottom number, the denominator, is profit or earnings. And so I'll give you a quick example that imagine there's two companies, and each of them produce about $1 in profit. And everything else about the two companies is similar. So all other things being equal, you could essentially buy one of these companies, that dollar profit, for $13. And in another situation, you could buy that dollar profit for $27, $28. Now, in this case, paying less is generally the more sensible thing to do. And I won't go into detail, but sometimes paying those higher prices is justified, either because those companies continue to grow faster than expectations. There can be a number of reasons, but generally speaking, paying less, all other things being equal, for $1 in profit is what we try to accomplish. And so those PE ratios, you can see that there was a huge dispersion in late 1999. Those large mega caps had run up, and those PE multiples had really grown to the high 20s. And meanwhile, small cap stocks were in the low teens, mid-teens for a lot of that period. And then the subsequent 10 or 11 years, small caps outperformed. So that basically created a pretty good entry point for small cap investors relative to large cap. And then we saw something essentially the opposite happen again in 2011, where those valuations narrowed. And then finally, if we look at where we are today, they've widened back out again. So does this mean small cap stocks are guaranteed to outperform over the next 5 to 10 years? Of course not. But it could be one reason why folks, at least those investors who do own small cap stocks, should feel hopeful about where they are today as a starting point relative to perhaps many of the different periods over the last 5 or 10 years. So hopefully that's helpful. Again, if you enjoy the work that we're doing here and would like to follow along, head on over to divvywealth.com, DIVVI wealth.com, and sign up for our blog. Just enter your email address in the box and click the button, and we'll make sure to send you updates as we post them, or go over to YouTube and search at Divvi Wealth Management and subscribe to our channel there. Thanks again for watching, and please reach out if we can help. Thanks. Bye-bye.